Ladies and gentlemen, good day and welcome to the Bajaj Finserv Limited Q1 FY23 earnings conference call hosted by JM Financial. As a reminder to all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Bhise from JM Financial. Thank you, and over to you, sir.
Thank you, Renju. Good morning, everyone, and thank you for joining us to the Bajaj Finserv Limited 1Q FY23 earnings conference call. Firstly, I would like to thank the management of Bajaj Finserv Limited for giving us an opportunity to host this call. From the management team, we have Mr. S. Srinivasan, CFO Bajaj Finserv Limited, Mr. Tapan Singhal, CEO Bajaj Allianz General Insurance Company, Mr. Ramandeep Singh Sahani, CFO Bajaj Allianz General Insurance Company, and from the life insurance business we have Mr. Bharat Kalsi, Chief Financial Officer of the Bajaj Allianz Life Insurance Company. Without much ado, I would now hand over the call to Mr. S. Srinivasan for his opening comments, and then we can open for Q&A. Over to you, sir. Thank you.
Thank you, Sameer. Good morning, everybody. Welcome to the conference call to discuss the results of Bajaj Finserv Limited for Q1 of FY23. That is the quarter ended 30th June 2022. As before in this call, we will largely be concentrating on the consolidated results as well as the results of our insurance operations through Bajaj Allianz General Insurance Bajaj and Bajaj Allianz Life Insurance Bajaj, and where material, the standalone results of our company, Bajaj Finserv. Bajaj Finaerv Limited, which is another major subsidiary of ours, already had its conference call. However, if there are any high-level questions on BFL, we will take that as well. We will not be taking any questions on the status of Allianz's stake in our insurance companies, except to state that the status has remained the same as at the end of the previous quarter, and there is no change. Any statement that may look like forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance result. As required by regulation, we have adopted Indian accounting standards. The insurance companies are not covered under Ind AS. They have prepared Ind AS financials only for the purpose of consolidation. Accordingly, for Bajaj and Bajaj, the standalone numbers that we will be reporting and talking about or put up on our website are based on non-Ind AS accounting standards or Indian GAAP as applicable to insurance companies. Our results, the press release accompanying the results, and our investor deck have been uploaded on our website yesterday. I hope you have all had a chance to go through it. Let me add a word about the additional disclosures in our investor deck. We have added an update on the policy administration systems adopted by both our insurance companies. These are under implementation, and one of them is under pilot implementation. These are designed from ground up, adopting relevant modern technology, and we expect that once fully rolled out, it will give the benefit of scalability and efficiency. I must highlight the fact that we will probably be the first to be predominantly cloud native, and this could be a new trend in the market. We have also added updates on our two digitally oriented subsidiaries, Bajaj Finserv Direct or Bajaj Markets and Bajaj Finserv Health, although they are not yet material subsidiaries under the SEBI ODR. We do hope these disclosures will be useful to our investor community. Coming to the performance updates for Q1 of FY23, conditions for business in Q1 FY23 were significantly better compared to the previous quarter of the previous year. Barring an increase in claims for Bajaj, overall it was an excellent quarter for all our businesses. Let me start with Bajaj. I think we had all-round growth, which was excellent. Individual rated new business premium recorded 81% year-on-year increase to rupees 895 crores. Group protection new business was up 76% at rupees 574 crores. Overall new business premium more than doubled to rupees 2,917 crores from rupees 1,296 crores in Q1 of FY22. On the back of renewal premium growth of 19%, the gross written premium was up 74% year-on-year. A matter of satisfaction for us is that over 3 years, compared to the pre-COVID period, Bajaj's growth in this Q1 is the highest in the market. During the quarter, growth was driven by all our main channels, with agency, institutional business, which includes bank assurance, brokers, corporate agents, and BALIC directs, growing at 63%, 68%, and 105% respectively. Unit-linked business was 38%, non-par savings 31% of the product mix, with par contributing 19%, annuity 9%, and retail term 3%. Persistency improved across all cohorts, with the 13-month persistency at 83% and the 61st month at 49%. While growing rapidly, BALIC has also recorded significant increase in its net new business value, or NBV. The NBV for the quarter was rupees 135 crore as against 25 crore in Q1 of FY22, with the new business margin improving to 11.1% from 4.2% in the same quarter of the previous year. In the life insurance business, quarter one is the lowest seasonally, as you are aware. And since fixed expenses get charged fairly equally across quarters, margins tend to be lower in Q1. Therefore, a double-digit margin in Q1 is a significant achievement. BALIC's profit after tax for Q1 FY23 was rupees 124 crore against 84 crore in Q1 FY22, is a growth of 48%. However, I must mention here that Q1 FY22 was impacted due to higher death claims and reserving on account of COVID-19, net of some tax reversals. Therefore, normally when you grow so fast, you would expect a new business strain, which is indeed the case, but it has been more than offset by the higher claims which we recorded in Q1 of FY22. I would like to highlight another significant development in Q1 for BALIC, which is that they have signed two new corporate agency agreements on bank assurance with DBS and City Union Bank respectively. We hope to see these contributing to growth from Q3 and beyond. If you recall, one of the gaps BALIC used to have a few years ago was on bank assurance tie-ups, and now with several partners, institutional business has become significantly large for BALIC. New tie-ups will also help us diversify business across partners. Let me move on to Bajaj now. Growth in GWP has been very good overall at 25%, and excluding tender-driven business of government health, it was 19%. Due to the strong growth and since we have to amortize premiums over the life of the policies, our net earned premium growth was just 2%. We hope the unearned premium for the quarter should get released over the next few quarters. The quarter also witnessed challenges on the claims front. We saw significant increase in motor OD claims, both in terms of frequency and severity. As growth builds up, combined with selective underwriting actions, we hope to stabilize this in a couple of quarters. While auto sales have just started picking up from its lows, it will be some time before it plays out in terms of growth. Due to very high traffic on the road, there was an increase in frequency of TP claims, and Bajaj has chosen to reserve prudently for TP claims. On the health front, Bajaj was cautious of retail health due to the possibility of a new COVID wave. Unlike life insurance, impact of a COVID wave is fairly immediate for general and health insurance. As things are stabilizing, Bajaj will seek now to accelerate growth. Bajaj will seek to strengthen the team in its health vertical and also seek to promote health insurance through marketing efforts. Bajaj has recently launched its first global health policy for Indian residents. We believe this is the first, probably among the first at least, if not the first in the Indian market. The pickup on its Health Prime rider, which was announced in Q4, which includes outpatient treatment and teleconsultation, has been very good since launch. Till date, we have sold over 500,000 such riders. With its extensive product range, outstanding service record on claims, and with marketing focus, Bajaj hopes to regain growth in retail health over the next few quarters. Overall, there has been an increase in the frequency and severity of non-COVID claims in the health business. Group health grew strongly as Bajaj was able to write more accounts on its own terms and also gaining advantage of some benefit products that it sells through NBFCs. Under the classification of IRDA, benefit products come under group. Claim ratio for health overall is lower in Q1 largely due to provisions for COVID claims in Q1 of FY22. Let me touch upon the commercial and corporate lines, fire, engineering, marine, etc. Although they seem to get less attention as they are not retail. This has always been Bajaj's strength and is a significant proportion of the market. We had another good quarter with Bajaj outgrowing the industry, and with its excellent reinsurance capacity and terms and the vast bank assurance network, Bajaj hopes to further strengthen its position in this segment over the next few quarters. On account of lower growth in earned premium and higher claims, Bajaj reported an underwriting loss of 61 crore and a combined ratio of 104.6. Profit after tax grew by 13% to 411 crores, held by higher profit on sale of investments of rupees 279 crore as against 132 crore in Q1 FY22. Overall, a good quarter for Bajaj, though higher claims was the challenge. Now to touch upon BFL briefly, an excellent quarter for the company across balance sheet growth, portfolio quality and profitability. Highest ever new customer acquisition in Q1. On track to go fully digital across all products and services on app by January 2023 and by web hopefully by March 2023. The assets under management or AUM crossed 2 lakh crores with an increase of 28%. Deposits grew strongly and are now 20% of borrowings. The gross NPA and the net NPA continue to be under control at 1.25% and 0.51% respectively. And BFL continues to maintain a management overlay of 1,000 crores on its expected credit loss provisions. Consolidated profit of BFL grew 159% to 2,596 crore. The pre-provision operating profit grew 37%. Bajaj Housing Finance continues to do well. At a 40% growth, AUM ended at rupees 57,425 crore, while net interest income grew 77% to rupees 595 crore. NPAs continue to be low, with net NPA at just 0.11%. It was only in 2017, FY 2017, that Bajaj Housing Finance started business on its own with a small book from Bajaj Finance. For 5 years, reaching 57,000 crores, we believe, is a very strong start for this business. On the back of growth and good risk metrics, profit after tax grew 96% to rupees 316 crores. A word on our consolidated results. On the back of strong results from our subsidiaries, the consolidated results were very strong. The consolidated total income was up 14% year-on-year at rupees 15,888 crore, when the consolidated profit after tax was up 57% at rupees 1,309 crore. This consolidated profit is after volatile mark-to-market losses on the investment portfolio of Bajaj and BALIC, which is recognized under Ind AS in the consolidated financials and which had a post-tax impact of rupees 283 crore. The underlying core profitability would have been significantly higher excluding this. Overall, a very strong start to FY23, and we do hope the momentum continues into the next few quarters. The last word you must have seen from the press release yesterday and the filings in the stock exchange that Bajaj Finserv has decided to split its rupee 5 share into 5 shares of rupee 1 each and thereafter give a bonus of 1:1, so that a rupee 5 share today will eventually become 10 shares of rupee 1 each. This will be after due approvals by shareholders. With that, I will pass it on to you for any questions you have or clarifications that you may need. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prakash Kapadia from Anived Portfolio Manager Private Limited. Please go ahead, sir.
Yeah. Thanks for the opportunity. Couple of questions from my end. So on the motor OD as well as TP side, we've grown, slower than industry in Q1. So is it, aggressive pricing by others, or, we were waiting for third-party hikes, or, certain segments we are avoiding? If you could give some color on the motor side, please.
Before I pass it on to Tapan, I'll give a broad look. See, all asset-based insurances, motor or property, when you go through a cycle where growth has been slow, then the growth doesn't pick up in the same proportion across the sub-segments. For example, in motor, if you see, it is a complex business. You have motor, OD, TP. Within that, you have two-wheelers, you have private cars, and then you have commercial vehicles that are goods carrying, passenger carrying. It's not that all of them have grown similarly. So as the growth comes back, whether we are a little bit here or there, vis-a-vis the market is not important, because there's only one quarter. We are running a long-term business. So we will pick up the growth on the segments that we want. Typically, Bajaj has always been conservative on the heavy vehicle segment, which gives very high severity of third-party losses. And therefore, as we go along, we will continue to focus on the segments that we like. Now I'll hand it over to Tapan to give a sharper flavor on this.
Sure.
Thank you, Srini. I think you summed it very beautifully. When you look at growth, I think it is in context in what we want to drive and how the market growth is happening for those particular segment of vehicles which is there. So it's a play of these two which takes on, and that is where the overall growth comes. So at times the segment in which we are driving, if they are growing better than the market, then our growth would go over the market. And if they are not doing as good as the market, then our growth would come under the market. And this also is dynamic. It's not that it's a fixed kind of segment. We have a strong team of underwriters, actuaries, and we keep on studying the market. Basically keep on deciding on what segment to push what. And that is why this is it is a dynamic movement. So the up and down is, I think it will just vary depending on the segment that we are focusing on. So thank you for your question.
And on the CV business, what is the kind of mix we would be comfortable? Because you said, that is more of a lumpy business, and because of third-party claims, the ratios are much higher. So what kind of a mix would we be comfortable on the CV side?
So again, in CV, it is not that all CVs have high third-party loss ratio. That's the point I want to tell you. It's a combination. So CV again has a variety of vehicles, and a lot of vehicles have low third-party ratio. So some vehicles have high third-party ratio. It's a combination of which segment are you looking at, and how do you want to grow it, how they're performing. So there's nothing which is good or bad in the market. I think in all portfolios you have business which to us looks good, and we want to service that well. And some businesses which are not priced right as of now. So those we look at very keenly to see when the price range comes to the point where we feel it is conducive for the right business, we write that business. So it would be wrong to say that CV has only high third-party loss ratio business.
And
just add to what Tapan said, it is very easy in a market to say that, CV or other business, whatever, the third-party business to get a very aggressive because, interest rates have gone up. But historically, we have seen in the general insurance industry that kind of cash flow underwriting doesn't work in the long run, because third-party being a long-tail risk, it will take some time for the losses on the new book to develop. So one has to balance that, and I think Bajaj has a very strong team which looks into all aspects of this in terms of geography, types of fleets, type of vehicle, and everything. So we'll continue to doing what has helped us so far, and we are quite confident that Bajaj will come back.
And in terms of annual mix, it would be what, 10 to 15% CV business?
See, in CV and all, we don't do that kind of mix as a target. We just do good business, what we think. We mix up some. Obviously, there will be some good and some bad, but overall, as long as we are doing the right underwriting, we should be able to deliver our profit. So the mix will develop according to that.
Right. And on the health side, what kind of a contribution do we expect from the government business on the group health side? And on the group health side, on the non-government side also, what has been our comfort in terms of claims ratio? Because, this is a business where, you will have lesser marketing costs. So what would be our comfort, and how do you manage risk on that side, on the health business?
I think there are two micro question for an analyst call in terms of how do we look at it. As mentioned earlier, I think business in which we find the pricing comfortable, we do that business because for us our belief is, and I think it has been demonstrated over time in terms of our grievance ratio or claim settlement ratio. Our belief is that companies with healthy balance sheet are able to service customers very well. And that is why we don't want the balance sheet to be spoiled. And we look at a track record and these are IDA publicly displayed data. We have least grievance ratio for quarters together and I would completely say for a decade now. And one of the best claim settlement ratio. I think so this is a testimony of the fact that our obsession to our customers has been on the highest. We look at NPS score also, I think it will be among the highest industry has. So the issue is that one should write business in which we feel comfortable in terms of the price, in which we feel that we service it very well. And that's how we build a long-term company. But to get to the micro detail of what the loss ratio should be, what particular segment should be, I don't think that I would like to answer that in my analyst call.
Yeah. And lastly, from my side, given that the industry is, having a higher combined ratio, I think last quarter it was 118% versus 112-13%. Does that, lead to unsustainable business for most of the players in terms of profitability and cash flows? And, is consolidation the way to sustain this business? How, because we've seen a lot of, new age players suffering because of, cash flows or profitability. So does consolidation happen in the industry directionally? What is our sense?
Tapan, I will start that. You do. Okay. This is a good question because, the industry cyclically, globally has gone through many cycles like this. When capital is freely available, when liquidity is strong in the market, I think there is a belief that, there is only one metric to be chased, and that is gross written premium. But unfortunately, in this business, the risk is open-ended, because the quantum of claims in relation to premium is significantly high. So over time, as the cycles change and capital becomes scarce, the ability to write business, which is losing, becomes very difficult. Now, I don't know whether that situation has reached in India or not yet. Right. But to us, writing business at a loss is not what we as a group in Bajaj have ever done. Therefore, we will watch as the things go by. I think when too many companies make losses and they have to continuously inject capital, at some point, one should expect that, some of them may not be able to survive. It is not a good way of running a business. Today, we sit on a solvency, one of the highest in the market, if not the highest, of 349%. And this 349% is the lowest capital infused in the business. And that represents the fact that the last 20 years, we have been profitable, despite the fact that industry has hardly been profitable in any of these years on the whole. So that is a sort of top-level answer to this. Tapan, would you add anything to this?
Yeah. So when you look at the combined ratio moving up, what I understand is the general insurance business, not only in India, across the world, is facing a very unique situation, which is high inflation. In the GI business, high inflation hits the business immediately. Why? Because when you price the product, you didn't take into account the inflation which may come up and rise so fast. So, be it a simple repair of motor vehicle or a health claim, or let's say when a factory is getting, again repaired or rebuilt, the cost of construction, the cost of repair of a vehicle, or currently, even for hospital, we see a very high inflation is built. Now, when you look at high inflation at a lot of places, people, revise the cost or the sale price to take care of the inflation cost. For the GI business, I think it has a lag. And that is why when you notice that, the movement of combined ratio so steep, I think that is why you see this combined ratio moving up. Now, about survival of companies, I think each company has their own strategy and how they look at it. We cannot comment on that. But if you look at it, a very long period, like Srini mentioned, for the industry which has gone through difficult combined ratio times, we already see a lot of stress for quite a few companies which is there. But I think they have to figure out their own strategy of how they want to look at it. We are building a company for hundreds of years, so I don't think we are in a hurry to cut corners just for that. So we continue to focus on long-term stability and long-term good business for customers, for our stakeholders in this business.
No, absolutely. I think I was, your philosophy and process and approach to running the business is very clear. This was more of a general industry consolidation view. If this will accelerate because of the way the combined ratios are. That was.
Yeah, I think combined ratio is not easing. As I told you, the inflation is going to hit it again. So when you see quarters coming through, you actually see deterioration happening, because the price has to at the price at which it was built for this inflation, I don't think it was taken into consideration. So that is why the industry would see a more difficult combined ratio. So I think it's a very valid question and a very relevant question.
And lastly, one on, life insurance. What kind of unwind rates do we expect in FY23, given that, we are seeing increase in interest rates across?
Bharat?
Yeah, I'll take that. So see, we take our best estimate as of now for a long-term unwind rate is around 8%. As you rightly pointed out, there will always be some moving parts during the year. So having anything like saying by March and what it would be, it'll be difficult because there are a few moving parts in terms of mark to market or the reserves which are over and above normally the SAT liability one has to keep it. All those plays in, but 8% is what you can imagine as a steady state unwinding rate for us.
Sure. Thank you. Thank you so much. All the best.
Thank you. Next question is from the line of Bharat Shah from Ask Investment Management Limited. Please go ahead, sir.
Hi, everybody. Two questions. One is on the competitive scenario in emergent kind of a picture, and second is more specific question about our two of our businesses. Coming to the first one, I think last 3 years have been kind of a cataclysmic period for want of a better expression. COVID, sudden heightened concern for insurance, sensitivity, digital models, tremendous flux, huge infusion of capital. And therefore, we've seen significant number of changes which have been brewing around competitively. And like we have seen in fintechs, where a lot of technology players are coming, but with poor understanding of finance. We have seen similar insurance technology ambitions burning on the funeral pyre. Given all of these, also the fact that digitization is an imperative, so that much like pure technology without insurance is a very bad business. Good insurance without technology will also be a lame duck, and therefore good mix of the two, I think, is emerging very clearly. So what not to do, I think, is becoming increasingly more clear. What are the insights, understandings, and strategic priorities for Bajaj Finserv insurance businesses in terms of what to do and what to achieve and how to go about it? In other words, the key strategic priorities given the tumultuous kind of changes which have happened in last 3-4 years.
Thank you, Bharat. I think a very profound question, I must say. In fact, insurance has also undergone a lot of changes. Companies are trying out different models. And the way we look at digitization, or the way we have achieved what we have, is we have digitized significant proportion of the customer experience. The entire chain of underwriting, the chain of the apps with which the distributors work today. Substantially, I think more than 90% of the policies now are issued digitally. But this, you may say, is just, the base of, because this has to be done. It is not something that you are doing which others may not do. But going forward, buying insurance on digital means it's a question mark, actually, because we find if you look at health insurance, for example, the products are not comparable across companies. So customers require advice. And even today, I believe a substantial portion, more than two-thirds of the health insurance market is driven by agents and not even by banks. So in this market, I think both our companies will remain digital. We will continue to invest in our agency and other intermediation channels. At the same time, we will offer the customer in terms of claims, customer experience, servicing, a fairly one-touch experience. Both our insurance companies now are in the process of just rolling out their new policy admin system, because the old systems that are available in the market and which we ourselves were using, one of them, have become outdated now. So unless you change the code, you will not have a agile, flexible system which can incorporate the changes that the market demands. This is a very long process. It is much longer for the life business, I must say, because of the every single policy you have sold pretty much has to be brought into the new system while you have to start with a new business as well. But having said that, in the health business, we rolled it out late last year. It is now stabilizing the retail health. We are now launched motor TP. Then we will go for the other products, which is motor own damage, and then the commercial line, then group health and all that. So we think the bigger problem is not digital transformation. The bigger problem is that there are a lot of companies coming in which are willing to burn money for an uncertain period of time. We do not know what the long-term game is for some of them. Maybe they have their own strategies. Maybe they are trying to get market share. But for us, the balance between three things are important. First is the quality of service which you give to the customer. In the long run, that is sustainable because customers who have good service will continue to be with you. Number two, we want to grow. We want to grow in line with the market, better than the market, but only in the segments that we think there is sustainable profit. And thirdly, we want to enhance the experience for our intermediaries and customers. The only thing I think last time you pointed out, which is very valid, was that we are not marketing our capabilities enough, which I think both CEOs have taken it well. And I would now ask Tapan and then Bharat to maybe comment further on what the individual businesses are, how they are looking at this trend.
No, I think, Srini, you sum it up so well that there's not much to add to that. The only thing is that it's a constant evolution I think the industry goes through. If I take the industry 20 years back, I think the motor claim settlement used to take 3 to 4 months, and that time the customer was happy with that also. Today, the motor claim settlement not only cashless, we also have facility in which when an accident happens, within the limited settlement idea, you get down from the car, click, put pictures, upload, and we transfer money on the spot only. So I think it's a constant evolution of how digitalization gets used. But the difference between a kind of a lending unit and insurance, the basic difference is, and this question I asked a lot of people across the world, who has ever got up to buy insurance? Today I'll buy insurance. I'm very excited to go and buy insurance. I've yet to find that. But people have got up to buy watches, clothes, cars, take loans, buy homes. They are excited about that. But insurance, the category, is not something in which people actually get up to buy. But it's a category in which when somebody talks to the person, they realize the importance of it. And it's an amazing product to have for the price it gives and the protection it gives. And then people buy. So it has always been a strong intermediary-driven business, minus some transactional business which happens. So the discretion in the insurance industry compared to a lending, the difference would be it will incorporate the ease at the front end for the intermediaries. At the same time, a very different customer experience for the customer in the time of be it claims or policy issuance. So a lot of investment goes from the insurance industry on these parameters to make a huge difference. And I said, if I just add up today, if I look at be it health, be it motor, be it even the commercial claims which are happening at the speed at which they're happening compared to, let's say, even 5 or 7 years back, there's a phenomenal increase in that. And we as a company have been on the leading or cutting edge of it. I think most of the innovations that has been in the new market, the ones that I mentioned, we are ahead of the curve, and some of it were actually the first in the world that we brought to the industry here. So I think that is our obsession because, as I mentioned earlier, the experience that the customer has with us is very important to us, and we keep on working towards that. Thank you for the question.
Oh, thank you. Thank you, Srini. Thank you, Tapan. For us, I think Srini has anyways covered a lot of things, and Tapan has also alluded to the fact that customer obsession is one of our focus areas. But if I put it broadly, the way we are looking at it has to be a sustainable and a profitable business at the overarching strategy for the company. Within that, there will be many initiatives which the company has already embarked upon, and we've been doing it for over almost last 5 years. So few of them also includes now the focus on tech and analytics, which will anyways kind of get the efficiencies also and put us in the forefront in terms of innovations or in terms of.
आपण ज्या व्यक्तीशी बोलत आहात त्यांनी आपला कॉल होल्डवर ठेवला आहे. कृपया लाइन पर रहा. आप जिस व्यक्ति से बात कर रहे हैं उन्होंने आपके कॉल को होल्ड पर रखा है. कृपया लाइन पर बने रहिए. The person you are speaking with has put your call on hold. Please stay on.
Sorry, I think I somehow was on hold. I'll just continue. So as I said, our overall theme has been about sustainable and profitable growth. So it's not always about being tactical in the market. And within that, the few drivers which we always believe and we've been investing into is one on the tech and analytics part. Second is on the product innovations. And the third is we wanted to be the choice of distributors in terms of the integration experience, in terms of the processes, in terms of the people we provide them at the ground for all support. All those has been our focus areas. And to drive the overall business, we are also investing into a lot of new engines of growth, whether it is a channel in a channel strategy or whether it is about going to the new market participants like Srini mentioned that we recently signed with DBS and CUB. So all those are our focus areas. That's where we are.
Bharat Shah, just one more point to add to this. In the insurance business, there are two things which will probably guide you towards assessing this question that you asked. One is that, insurance historically follows experience-based pricing. That means, unlike finance and others where you work on a lot of parameters, you identify the good risk from the bad risk and try to focus more on the good risk. In insurance, you actually write a volume because geography is important. And therefore, when you write a volume, you get to know the experience. And this is a business you can never be where you write only good business. Because if all your customers don't have claims, they will stop insuring with you. So therefore, it's a question of mixing good with the bad. And the more volume you write initially, you will be able to then call out what you don't need, or then using analytics, you will continuously refine that portfolio. So that is how you manage the risk in insurance. And globally, I think it is still experience-based. Even the catastrophe and the large risks are based on experience. Although there will be some input from external assessment of parameters that drive claims, largely I think it will be experience-based. So this is one thing. The second thing is the incidence of fraud is very high in both these businesses. The amount of benefit one can get for a small amount of premium is very large, which is very attractive for the fraudsters to exploit. So therefore, we are spending a lot more. More companies have very strong what we call loss mitigation and fraud management departments, and we continuously invest in analytics there because we think that is very important. We don't want to have too much of these fraudulent claims affecting the P&L. Even if it's a small percentage, it can actually bite into the profit margins, which are anyway very thin in this business. So these are two other things which will drive how we use it. And lastly, even if you acquire a customer digitally, servicing them digitally, we are still way, there's a long way to go. We have to deal with motor workshops. We have to deal with hospitals. Many of them are not technically equipped to be able to, get paid and settle claims fast. Although that number is increasing, there's still a long way to go. And lastly, in terms of motor third-party claims, it is dealt with by more than 1,000 motor accident tribunals, and it's a legal process which takes and quite a long time. So these are things, even if I acquire customer digitally and I want to do business digitally, I will have to invest in these in the traditional way. I must have people who will build these networks. I have people who will manage these networks. I will have to have partner management, so many other things, along with the technology to support it to make it efficient. So it's a complex matter. And as things evolve, we have to be agile and change. And that is the direction that we normally take. So digital for us does not mean B2C. It just means enhancing customer experience and partner experience. I don't know if we have answered your question well or not, but I think off the cuff, this is what our thinking is.
No, I actually, Tapan, Bharat, all have answered it well. It was less of a question. I was seeking more of a assurance and reassurance that our model is not trying to get tempted into following tactical paths. I honestly am not worried on people who are ready to burn capital, who have more capital and less ideas. That bouts of insanity happen time to time. Of course, it is painful for sensible players while capital is being spent loosely because it creates disturbance for some time. But eventually it gets sorted out. It's an irony that business of risk, those who are supposed to underwrite risk, are themselves are following business models which are seemingly uninsured. I mean, also on a conventional player, who is large player, when suddenly there is a strategic change of the priority, where priority shifts to growth rather than capital efficiency, while I would have thought it is always both and never only one, it puts some worries and doubts whether the companies are on the path or not. So it was more seeking confirmation and assurance that quality, growth, and all together is what we are pursuing, and that answers it. Thank you.
Thank you.
Yeah. The second question is more specific. One is about cross-selling, and second is about health insurance. While I know cross-selling is easier said than done, but Bajaj Finance has shown the way in the finance business how to use cross-selling as a tool very intelligently, not only to acquire more customers more efficiently with shorter time frames, but with better risk profile and reduce the cost of customer acquisition. I understand the parallel doesn't follow similarly in insurance with some specificities of the insurance. But I think cross-selling as an idea somehow doesn't appear whether insurance businesses of Finserv really have it at the top of the mind. The second one is more specific, that an important, large, conventional opportunity like health, when we don't focus in good time and serious long-term players like you, one would have thought would have carved out a very large activity by now, where we still are seemingly in a catch-up mode and trying to find our feet wet. So I thought on both of these wanted to understand the mind of the management.
Right. I will take that the top level first, and then Tapan and Bharat can add. On the health business, you see, we are very strong on group health, employer-employee. And unfortunately, that has been a business which always has been subject to pricing because it is an HR cost for companies. But over time, I think it is not that we are either aggressive or not aggressive. It is just that we do business on our terms where we see, for example, in a corporate with employer-employee, we always know what were their claims last year, how many employees they had, how their employee strength is going to grow. We can make a reasonable assessment. And with inflation, we know how much it is going to cost. Now, if somebody is going to bid 30% below that, we obviously won't participate in that. But if there are many corporates, we are focusing more and more on the service aspect of it. And hopefully our health company will also, as it develops, will be able to deliver some more value onto that. Hello?
Yes.
Yeah. Coming to cross-selling, I think last 2 years there has been a significant focus on both the companies on cross-selling. The problem with general insurance is that a value seeker eventually becomes a price seeker if they do not have the benefit of service. Number two, while there are large number of products, a lot of people are not, for example, if you take homes, the only way some amount of home insurance sold in India is only when it is bundled with the home loan. Otherwise, people around us do not buy it. Over time, hopefully, it will become more important for people to buy home insurance because something happens to the house or anything, then the loan and other things will get repaid or they'll have at least the losses recouped. But there are many things like this. You know, we have launched pet insurance. So the products are available now, but selling them is not that easy because people aren't, as Tapan said, getting up every day morning saying that I want to buy some insurance. So cross-selling is on. In Bajaj, we are running a loyalty program where we are trying to now deliver, but that will take a few more months before it is rolled out fully because it requires a lot of capabilities to be built in the company. The analytics teams in both companies are now well established. They are working on a lot of data and we will try to bring that. In Bajaj, again, getting the customer and keeping them was itself used to be a challenge for the industry. Now we are keeping them with a higher persistency and all that. The next step is obviously to ensure that they also give us more of their future savings. So from a pure opportunity perspective, what you said is right. Health is a population business and therefore over the next 15, 20 years, India will offer tremendous growth. In terms of life insurance, even nominal rate of GDP grows 10-12%. The amount of savings pool coming into the industry is going to be huge. So the opportunity is huge. The market is very competitive. Everybody is trying to take other people's share. But hopefully as a strong company, which both companies generating capital, we have the wherewithal to survive it. That's all I can say at the top of the mind. Tapan, are you there? Or Bharat, would you like to take it?
Yeah, I'm there, Srini.
Yeah.
So if you look at it, in the general insurance space, we are a big health insurers. I think in the SAHI space, SAHIs have done good in terms of the penetration on health. Now they had an arbitrage, or they have an arbitrage in terms of the number of agents they can acquire without training. Existing agents can become SAHI agents. And that is one of the reasons why I think the SAHI did much better than the general insurance company. So it is not that we are trying to get our feet wet. We would see that we are a major health insurance player in the Indian market as it is. What we have been saying is that we want to scale it much further. We want to become the dominant player, including the SAHI players as time progresses. And the arbitrage which may be there in acquiring agents, but that is perfectly fine. We have a massive distribution network, and how do we build on that? That is what we have been saying. So first and foremost, I think the point is that we are already a big player in the health insurance space, and we would be scaling it up further, taking it up. I think that is how we look at it. Now, if you look at health also, with all this, the entire industry working on, the entire total population covered would be just 14-15 crores of the number of policies. In fact, the government health insurance scheme covers about 40 crore Indians which would be there. So there is 70 odd crores which is the missing middle. I think so. The opportunity for growing health is huge. The way we look at it, and how do we look at handling the middle and middle? How do you put it together? That is what we have been saying. So I think it should not be misconstructed as that we are still trying to get our feet wet. No, we are firmly into it. We are a large dominant player into the market, and we see a huge opportunity in the Indian market context in terms of the health insurance can be there, and that is what we are working on it. To the point, cross-sell again, like Srini actually summed it up. That is something which I would say when you look around, it is not about, and that is when we compare different industries, it's like an apple and orange comparison. It gives a wrong perspective. should compare within the industry. So let's look at in the general insurance industry across the world. Let's say we look at the financial, we heard about, the Wells Fargo story. We heard about all the stories across the world of cross-sell being there. But has anybody heard about stories like this in the general insurance space across the world or anywhere in the world, no? So fundamentally, the way we look at cross-sell would be very different from the way a financial services cross-sell would be happening. I think that is where the stories also come up. And it is again because of the way customer looks at this category and how they look at it. So I think more than cross-sell, what we should look at is that are we covering the customer for his entire protection, which I have always believed strongly that a customer should have a good health insurance, a good home insurance, a good PA cover, a good cyber liability cover on a retail basis, no? And then what is a good travel insurance cover, no? And these doesn't cost much. I think 5 or 6 cover customer should have. So the obsession of the company is that when somebody is a customer, are we working hard enough to have a complete protection for the customer, at least making him or her aware? I think that is our approach we do it. And that obviously in a very, I think simple term can be called cross-sell. And I think our endeavor is to keep on doing that because we are obsessed about the customer. And we should see that something goes wrong with the customer, we should have insured the customer and he should or not, she should not be left uninsured. That is what as a philosophy the company is pushing. No, but thank you for the question. It's a very, very nice question.
Thank you. Thank you, Tapan. Thank you, Shani. I think you covered most of the things. But with respect to BALIC, I think again we have to look at 2 things. One is the upsell part and the other is the cross-sell part. So BALIC in terms of upsell has been, I think, covering up both grounds. We are already seeing almost like 20% of new business comes through upsells. No, that is not specific to the Bajaj Group per se, but all our existing customers where we can further go back and sell them a next policy. So to that extent, upsell is working fine. And from a cross-sell perspective, see, this has always been an opportunity. So if I specifically talk about, say, BFL customer base, numbers are not as relevant as in terms of percentage to the business, but has this been improving year on year? The answer is yes. Is there a group business with them is improving year on year on a strong growth? The answer is yes. But given this a small base and a large opportunity, have we really penetrated enough in that? Maybe it is still a journey which we are walking on, and there are a lot of new initiatives which we have taken. So all in all, cross-sell within group is the further opportunity is there? The answer is yes. And otherwise on the upsell, is BALIC there? The answer is also yes. That's where I will stop and happy to take any further question on that.
Sure. Thank you and wish all of you the very best.
Thank you, Bharat.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit yourselves to 2 questions per participant. Should you have a follow-up question, we would request you to rejoin the queue. Next question is from the line of Dhaval from DSP. Please go ahead, sir.
Hello, am I audible?
Yeah.
Hi. Thanks for the opportunity. And I had 3 questions. First was relating to in Bajaj specifically, all 3 of them. The first one is relating to OPEX. I think the group is and the company is making several investments on distribution and technology. So just curious to understand as we progress into the year how we think about OPEX and OPEX growth. And the second question is relating to profitability. So at a high level in Bajaj, would you expect next couple of years revenue growth, like premium growth and profit growth to be broadly similar, or there could be investments upfront and benefits could come later, which means that profit growth will lag premium growth? And the third question is more just sort of a more product specific strategy. We've seen in the industry this embedded insurance business sort of pick up, be it trip insurance, mobile insurance, etc. All those categories have picked up. I just wanted to understand, we have a very strong small ticket sachet insurance business, and also technology is sort of one of the key pillars in this embedded insurance business. So I just wanted to understand how we think about this business and is there a sort of long-term game plan around sort of is it profitable, and is there a long-term game plan in this space? Yeah. So those are the three questions. Thanks.
See, broadly on the sachet bit, sachet is a good way to acquire a customer, but then the industry has to be prepared and the customer has to be prepared to expand that sachet product into long-term indemnity products. The insurance is not like some other services where there is a trigger, right? Yeah, I buy a home, so I'll take a home loan. Once I've taken a home loan, then the company comes after me to collect the money. But insurance is a journey. And in the journey, they will first buy a product, any product they can buy, but later on, usually it is motor. But now some may enter through sachet, and over time, as awareness increases, they will buy more and more products. And the companies which are strong and who have the best product range and the best customer service, hopefully will be in a better position to attract those customers. It is possible that one customer can have multiple products with multiple insurers, and there's nothing which prevents them from doing that. But this largely remains, you cannot build a business on sachet unless you are willing to burn a lot of capital, because it does not give you the risk reward in terms of profitability is not there in that business. The other question on OpEx and to add to what I said, I would leave it to Raman and Tapan to handle it.
So I'll take the one on OpEx, Srini. As Naval, if you recall, in the past also we've highlighted that our OpEx ratio over the last few years had gone a little higher, and last 2 years I think we did a lot of consolidation. And if you look at the OpEx expense ratios, actually they've been coming off quarter and quarter for over 2.5 years now. But like I mentioned in the last call also, see, there are investments which we had held back because of the pandemic. But I think now that the pandemic is behind us, we plan to scale up geographically on a distribution front also, in terms of technology. All of this is actually now being invested into. So, just to give you some numbers, our peak headcount used to be about 12,500 to 13,000 people. And during the course of the pandemic, we actually scaled it down and we're down to about 8,500, 9,000 people. But given that the pandemic is behind us, now we'll start scaling the manpower front. Plus, we've also, like Srini mentioned earlier, we are investing a lot in technology, and with this massive transformation going on the policy admin side, we are running two systems parallelly, our old policy admin system and the new one. So another 2 years, I think this parallel run and also doing a hybrid of the cloud and the on-site, this will add to some amount of cost. So, for at least 6 to 8 quarters from now, I believe that the investments will add to the cost. Productivity may or may not shape up the way we want it. So that's just a word of caution on the expense piece.
Does that answer your question, Dhaval?
Any comment on the profit growth versus sort of premium growth? Any broad high-level comments?
See, broadly what happens is when you make these investments, if they are fixed cost investments, then operating leverage will take time to develop. You first invest, then you get the business, and in insurance, the premium gets accounted over 12 months, so it takes a longer time to recognize the revenue while the claims and other costs come up front. So there will be a cycle. However, we'll have to balance that with our need to grow the profit as well as the opportunity that is there, the profit that the new business will give us. That may take a couple of years to evolve. The one good positive sign is that over the next 2 to 3 years, it seems like the investment yields are going up. So that should provide some cushion. The underwriting side, there are pressures of inflation, as Tapan pointed out. So this will balance out. And I think we have a very rigorous long-term planning process across our group. And we also have backed it up with a very strong annual operating plan, which runs a series of projects across the companies. And hopefully that is the ability is to build capability. And sometimes we have to make some investments upfront. Luckily, we are in a good position that we have generating capital. So we do have money to invest, but we have to see how the market goes.
Got it. Thanks, Srini. And, just thank you for sharing the additional disclosure in Finserv Market and Bajaj Health. Really useful. Just one small question on Bajaj Health. If you could broadly lay some context of how much Bajaj Finance contributes to, the current business in terms of be it the user base or, paying user. I mean, some way of, explaining how much is, own organic effort and how much comes from, one of the...
I don't have the exact number and we're not disclosing that. But Bajaj Finance is selling health cards along with its loans. However, the big thing for them is that the health cards, when people want to use the service of doctors or diagnostic centers and all, they need Bajaj Finserv Health to provide that service. So there is a base cost and there is a loading on that. So on the OPD side, the B2C product that we sell, or it's rather B2B2C, quite a lot of it is done by Bajaj Finance. They do a lot of direct business also through their digital marketing. In addition, they also offer the service, the helpline rider of diabetes service by Bajaj Finserv Health. So they will be investing. They are also doing some other pilots on some other areas. And we hope there is enough opportunity there as well. Outside of illness, they will be focusing more on wellness. So we think the business is scaling up quite well. We have about 100,000 doctors now. And the number of customers using our app is also increasing. Our apps are highly rated on the Play Store. So we are quite confident. It's a growing ecosystem. We are a wave one partner for the National Digital Health Mission. So we are there. I think whether the customer is ready or not, we are helping them get ready, And I think we are seeing the initial thing of people are liking it.
Understood. Thanks and all the best. Thank you.
Yeah.
Thank you. Next question is from the line of Sanket Goda from Spark Capital. Please go ahead, sir.
Thank you for the opportunity. Sir, just wanted to understand the motor OD part a little better, given we have reported loss ratio, which is probably the highest we have reported in many quarters. So you alluded to the point that it is inflation. So just wanted to know whether we are able to do a price correction because inflation is now real, and our competition is not allowing it to take a price hike, and therefore from full year point of view, should we see these numbers to remain at these levels? That's on motor OD. And similarly on TP, you alluded to the point that we made little reserves, or we have been conservative. But how do you see this full year to play out, this 89% loss ratio in motor TP to play out for full year? That's on Bajaj, and I have a couple of questions on Bajaj which I can ask after you answer this.
Okay. So first, I think at the top level, I think we are seeing what is happening in airports across the world in terms of their ability to handle the pent-up demand of people wanting to travel. Somewhat, I think motor is like that. Having said that, when the claims happen in motor, it's not of the current book that you're writing, it is always of the past book. And when there has been a period when the auto sales have been down, you will find that later on, a year or two down the line, you have higher claims because the premiums you earned were not sufficient to cover that. So this is cyclical, and as auto sales pick up overall, we think this will get evened out. Many cities, I think metro work is going on, causing traffic chaos in many places.
This call is now being recorded.
So that is another factor, that if a number of cars on the road and the roads are not expanding every day, is obviously causing some extra frequency. In terms of pricing in motor, is an open pricing. It's not like there is a fixed price, and it depends on the segment you want to target, the intermediary through which you are dealing with, and how you can get the better price. Tapan, would you like to add to that?
No, I think what you said, Srini, is the answer. See, if you look at it, and this will be visible to everybody, if you go out on the street today, you see more motor vehicle on the street, on highways compared to even pre-COVID time also. So the frequency of claims obviously goes up because the more vehicles that hit the road, there would be. Coupled with frequency, you also have severity increase because of inflation. These two would play out. Now, is this a permanent phenomena or will it over time balance out? Is what the question should be in terms of, because that is going to determine how the loss ratios shall move and is it a short-term phenomena. Now, for the next at least a couple of quarters, this would play out because, as Srini also mentioned, the pricing is on the past assumptions, and this spike in frequency and inflation is not something somebody would have predicted. It will increase it extrapolates so high, So obviously, this will take a couple of quarters before it can correct itself, in the market as it progresses. So we should be there to answer your question that do you see immediate correction? No. It takes some time before the correction would happen on that. But does the phenomena remain like this? Does it eve out? No. Are the questions that has to be answered to get your pricing right as it progresses further.
Got it. On motor TP side, sir? The reserve which you have additional.
If you look at, the reserving happens on the assumption of how the frequency is and how the settlement is happening. On both, if you look at the inflation in the TP settlement also, and if you look at the inflation also, frequency increase also, it has increased there also. So as a company, I think we are very careful and look at also when we publish our triangle, as we call it, you always see that we have releases. So we are very,
आपण ज्या व्यक्तीशी बोलत आहात त्यांनी आपला कॉल होल्डवर ठेवला आहे. कृपया लाइनवर रहा. आप जिस व्यक्ति से बात कर रहे हैं उन्होंने आपके कॉल को होल्ड पर रखा है. कृपया लाइन पर बने रहिए. The person you are speaking with has put your call on hold. Please stay on the line. आपण ज्या व्यक्तीशी बोलत आहात त्यांनी आपला कॉल होल्डवर ठेवला आहे. कृपया लाइनवर रहा.
I think the hold button must have got pressed by you because to not speak. Yeah. So coming to the point, so even TP also you see increase in frequency and you see that as a company, and that is why we publish these triangles also. You always see there will be reserve release, which shows that we are very, very clear in terms of our reserving, and it's a very good reserving methodology that we follow at all points of time. So when we see this happen, we obviously strengthen it. We feel that in times to come, the TP would start. So we strengthen it again. But let us say over time, the frequency drops, then obviously, there would be a release again in terms of how to look at it. But it's always better to be cautious on reserving than to, go overboard on reserving. So that's what we did.
Got it, sir. So on Bajaj Life, just a couple of data keeping questions. Just wanted to understand how much Axis Bank would have contributed to the total premium growth, or how much it contributes to the individual rated premium in the current year, in the current quarter rather. And second thing is that protection business still doesn't seem to have seen a traction because all other products have done very well. The protection business still have declined. So how do you see, especially the individual protection, and so how do you see that to play out going ahead? And finally, on margin, I just wanted to understand the 11.1% margin in the current quarter. Can we expect that full year to be closer to 20s, given the product mix and the cost overruns issues might iron out by the end of the year?
Thank you, Sanket. I'll take the questions in the order. So your first question was about the Axis Bank contribution. So see, if you know that what has happened is Axis Bank branch banking we started sometime last year, second half. So obviously this first half it will have some contribution effect in terms of not being there from a branch banking. We were always in the liability sale for last 2.5 years. With that, for time being, the share of Axis Bank in our business is around 25%. That's for the first quarter only. Your second question was on the protection. So see, for protection, as you would have seen for everyone, the protection business either in absolute or as a percentage has come down. But if you look at on a sequential basis, our protection mix is there and thereabout. Rather, it has just marginally up only, but only few basis points. And what is happening in the overall protection space, as you know, that people are now a little bit more calibrated as to how they are taking. Companies are undergoing a lot of underwriting processes change given what has happened in the past, and the reinsurer arrangement is changing. And we are also going with a very calibrated approach in terms of how we want to take the risk on the books, whether it is strengthening the underwriting practices or the reinsurer pricing and all. What we have also done, we have launched relaunched another product with lot many new features and a better underwriting process. So I hope as the market grows up back on the protection business. Our share is expected to be improving on a quarter-on-quarter basis. So that's on the protection side. Third year was on the NBM, which is at 11% for the quarter, as we never provide any forward-looking guidance on the full year basis. But as Srini in the opening remark also mentioned that having a quarter one with a double-digit number, I think it's a good start. Last year, our full year number was around 14.2%. So I think we are on the right trajectory. Lot many things depends on how the year ends in terms of growth, product mix, what happens to protection, how the non-par saving is playing in, so, and the overall business cost and all. So there's no forward-looking number per se, but as I mentioned, we are on the right track. So hopefully we'll have a good year by the time we reach March. I hope that answers.
Got it, Bharat. Thanks for the answer.
Yeah.
Thank you. Next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead, sir.
Yeah, hi. Thanks for the opportunity. Just one point on I mean, first of all, again, congratulating again you for sharing this data on Bajaj Markets and Bajaj Health. So just wondering in terms of in your assessment, the data, I mean, any metric you are tracking, is the performance better than what your expectations were, or I mean, is there a further headroom for the metric to sort of grow? So one would be on that, and second would be on in terms of investments. So we've already infused around 807 crores in Bajaj Markets. I mean, do we further need to invest in the ecosystem? That would be the second question, sir.
Yeah. See, it is an evolving business. We have to look at it like a startup, right?
Yeah.
So when you look at it like that, I think the companies have done remarkably well. They are well in better than our plan. If you look at Finserv Markets, for example, which is the older of the two, you can see the metrics are all shaping up quite well. You know, we have organic visits, which is about 5 million customers. We have 104 crores of revenue, which is the revenue they have earned. The app registrations are going up. We have 1.3 million app registrations, and we have 146,000 transacting customers. Obviously, as the kind of variety of products that they sell, from high ticket to low ticket, obviously they will have to focus on these metrics in improving these. From a capital perspective, we think that they are good till FY24. Okay. After that, if the business model scales up further and we reach our goals, there is a possibility that FY25 on the existing business, at least we will start cash break even. This is our goal. I'm not saying that we'll reach there or not there. We'll have to wait and see because it's a long way ahead. But incremental capital requirement we think will be less. However, if growth is significantly higher than what we anticipate, clearly we need to continue to create capability. A lot of the investment we do is largely on people and technology required at the back end to drive a digital business like this, and in building the network of partners and expanding the product range that we offer. So we'll continue to focus on that. And as a concept, as a business, I think the path is clear for us.
Okay. So just clarifying, so we have given transacting customers and visits, and first of all, this is only an app platform, right?
Yes.
And so registered users is 1.3 million, which you just mentioned.
That's right.
Okay.
People have downloaded the app, yeah.
Okay, great. Fine, sir. And just lastly, I mean, I think we've touched a lot or discussed a lot on the combined ratio part. So, I mean, based on what we have sort of mentioned, so, I mean, for the next couple of quarters, I mean, the combined ratio, even for Bajaj, I mean, usually, I mean, in the history, we always sort of have seen that combined ratio had remained below 100%. But given the competitive intensity, even for Bajaj, next couple of quarters, I mean, the combined ratio above 100%, I mean, is that what we are guiding? I mean, given the challenging environment?
We are not giving any guidance. We don't do that. All we are saying is that, yes, this quarter we have grown quite well. We have earned premium has grown only 2%. So on the one side, whatever premium we have booked till now will get earned over the next few quarters. At the same time, we'll continue to grow, and as Raman said, we will also be continuing to make investments in expanding distribution, technology, analytics, and all that. So there will be some element of cost as an investment. And the claims we have already discussed at length. There is an element of uncertainty how they will pan out. As they all come, the combined ratio is a result of all that. Our focus is on continuing to do what we do well, underwrite well, do good business, retain well, invest the cash flows, and earn return on that. We'll continue to do that, and I hope that as things turn out, we will be agile enough to do that.
Yeah. That's helpful.
Yeah.
Thank you.
Right. I think we'll take just one more question. We've already overshot the time.
Thank you. The last question is from the line of Anand Bhavnani from White Oaks Capital. Please go ahead, sir.
Thank you for the opportunity. Sir, just wondering, for our Bajaj markets, do you have, any specific numbers as targets, like for the, Bajaj Finance equivalent, we had some targets the other day shared. So for markets, do we have any such targets for the full year or?
It's an emerging business, and whatever targets we put can go either way. So we don't actually give targets for any of our companies. Bajaj Finance does that sometimes as a general guide as to the range at which they would like to operate. So we are showing the numbers, and we will continue showing those numbers every quarter. Let us see how it goes. We have explained what we want to do in one slide, and we have given the key metrics that we think are to be tracked for both our businesses. And as we go along, but I think the revenue is an important factor to generate 146 crores of revenue. I mean, whatever that revenue is on 146, but we are generating good revenue from both the companies. I mean, that's very important for a startup.
Noted. And so secondly, on the health card, how many health cards would have we kind of sold in the quarter, and what percentage?
Transacting customers is that only, paying customers.
Okay, so all the transacting customers
are paying us money, right, for using the services, yeah.
And what percentage would have been through Bajaj? So we have 493.
That we don't know. I mean, a lot of it will be through Bajaj Finance, but Bajaj Finance is only a distributor. Ultimately the service is a card you sell today, but you have to provide the service, right?
Yeah.
They run lead selling cards, and that is where the capability is of Bajaj Finserv Health.
Noted. All the best. Thank you.
Thank you.
Thank you. Due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to Mr. Anuj Narula for closing comments.
Thank you. On behalf of JM Financial, I would like to thank Mr. Srini sir, the senior management team of the insurance businesses, and all participants who have joined us on the call today. Thank you, and have a good day.
Thank you all.
Thank you. On behalf of JM Financial, that concludes